Picture a middle-class retiree in Buenos Aires as the calendar turned to October 2001. This individual represents the pinnacle of fiscal responsibility, a person who spent 35 years laboring at a manufacturing plant and diligently setting aside 20% of every single paycheck. They lived a life of cautious discipline, avoiding the siren song of debt and anchoring their future in the three pillars of traditional security: bank deposits, government bonds, and a life insurance policy. That policy was more than a contract. It was a legacy suggested by a father who believed such instruments were the only way to truly protect a family's well-being. By November, the surface of the Argentine economy remained deceptively calm, with the peso still pegged firmly to the US dollar. The government issued sweeping guarantees of stability, while banks sang a chorus of promised liquidity. Even as the tide began to pull back, financial advisors urged their clients to remain motionless, insisting that the only rational move was to stay calm. The silence was shattered in December when the government enacted the Corralito, a brutal freezing of every bank account in the nation. Suddenly, the very gates meant to protect the retirees' wealth became the bars of a cage, rendering personal funds completely inaccessible. Within a matter of mere weeks, the peso underwent a staggering 70% devaluation, because every asset, the savings, the bonds, and that cherished insurance policy, was denominated in the local currency. Two-thirds of their purchasing power evaporated before the owner could even attempt a defensive maneuver. This was not a failure of character or a lapse in work ethic. It was a failure of premise. The victim had operated under the assumption that the structural foundations of the economy were permanent, when in reality, they were merely a temporary scaffolding. This tragedy reveals the cold machinery of a currency reset. When a government's debt crosses a terminal threshold and interest payments begin to devour the majority of tax revenue, the political machinery often finds itself paralyzed. Unable to stomach the social unrest of spending cuts or the economic drag of tax hikes, the state pivots to the only remaining exit. The currency must adjust. In this grand shifting of a ledger, certain asset classes are essentially designated to serve as the sacrificial lamb, absorbing the massive losses required to balance the books of the state. It is a recurring nightmare that has played out in Weimar Germany, Zimbabwe, Venezuela, the Soviet Union, Brazil, and Yugoslavia. To understand this pattern is to realize that these crashes are not random acts of God, but the predictable conclusion of a specific financial architecture. By treating these events as a forensic investigation, we can identify which investments are structurally destined to crumble when the sovereign debt clock finally runs out of time. Many people mistakenly equate a currency reset solely with the terrifying imagery of hyperinflation, the wheelbarrows of cash in Weimar Germany, or the absurd $100 trillion notes issued in Zimbabwe. While those represent the most violent volcanic eruptions of monetary failure, they're merely the most visible points on a much wider spectrum of destruction. A true currency reset is any fundamental restructuring of the relationship between a legal tender and actual, tangible value. This can be orchestrated through devaluation, redenomination, or draconian capital controls, and often, a state will utilize all of these levers simultaneously. The universal constant is that assets tethered to the old system bleed purchasing power, while assets rooted in real things survive the transition. Consider the seismic shift of August 1971, when President Richard Nixon unilaterally ended the conversion of dollars to gold at the fixed rate of $35 per ounce. While it lacked the immediate chaos of a street riot, it was a profound reset. Within a decade, gold was trading at over $800 per ounce, a price movement that reflected the dollar's precipitous fall rather than an intrinsic surge in the metal's value. Similarly, in 1960, Charles de Gaulle introduced the nouveau franc, replacing the old franc at a ratio of 100-1. Like a sudden shift in the tide, pensions, bonds, insurance policies, and bank accounts were reconfigured overnight by the simple movement of a bureaucratic hand. The assets remained on the books, but their fundamental nature had been altered forever. Consider India. In 2016, the government announced demonetization of 51,000 rupee notes. 86% of all currency in circulation was declared invalid with 4 hours' notice. The explicit objective of such maneuvers is the surgical destruction of unaccounted wealth. When fiscal mathematics reach a point of no return, governments do not view these events as unfortunate accidents. They view them as necessary tools. Consequently, millions of individuals find themselves abruptly severed from access to their own capital. This is not a random glitch in the system, but a feature designed to engage when the state's survival is at stake. The reality that your primary store of value could be a pre-planned sacrifice in a much larger game is a concept that demands deep reflection. When a sovereign power finds itself strangled by debt it cannot satisfy in real terms, it faces a trio of grim choices. The first is a total default, a flat refusal to pay. This path is almost never taken voluntarily because it is a political suicide mission that nukes credit market access and sends politicians to the unemployment line. The second path is austerity, characterized by savage spending cuts and aggressive tax hikes. History shows this rarely works at scale, as it typically ignites street riots and ensures electoral defeat. The third, and most seductive, path is inflation. By printing the currency needed to settle bonds at their nominal face value, the state effectively wears a cloak of invisibility. Bondholders are technically paid every dollar they were promised, but those dollars possess the purchasing power of ghosts. In this scenario, the long-term bond acts as the primary valve for wealth drainage. They are the instrument through which governments transfer the cost of their debts from themselves to their creditors. History serves as a graveyard for those who mistake nominal payment for real value. In 1923, Weimar Germany provided the ultimate warning when government bondholders were annihilated. Bonds maturing that year were settled in marks that held less value than the physical paper they were printed on. The United States is not immune to this invisible theft. Between 1940 and 1980, holders of long-term treasury bonds were paid in full, yet they watched helplessly as inflation devoured over 70% of their purchasing power. Brazil's experience in the 1980s and 1990s was even more frantic, characterized by a revolving door of currency reforms involving the Cruzeiro, the Cruzado Novo, the Cruzeiro Real, and finally the Real. Each new name on the banknote effectively acted as a shredder for the fixed income instruments denominated in the previous currency. The mechanism remains chillingly consistent. Governments rarely default in the traditional sense. They simply redefine the value of their promise, keeping the nominal word while liquidating the real substance. This is where the structural integrity of the system breaks. It leads us directly into the second asset class destined for failure: cash and cash equivalents. Cash is a psychological trap because it feels like a harbor in a storm, offering liquidity when the world turns volatile. However, cash is not wealth. It is merely a claim on wealth, and every claim can be diluted by the issuer. There is a mathematical identity that governs all currencies. The total amount of currency in circulation divided by the total amount of goods and services in the economy equals the price level. When the supply of currency outpaces the production of tangible goods, prices must rise as a matter of mathematical certainty. This is not some abstract economic theory. It is simple, brutal arithmetic. Since 2008, the Federal Reserve's balance sheet has exploded from approximately $900 billion to nearly $8 trillion. That is not a typo. In just 16 years, the monetary base has increased by a factor of 8. While many find comfort in the fact that consumer price inflation did not increase by that same factor of 8 during this period, that comfort is merely an illusion of safety. The inflation was undeniably real, but it was distributed unevenly, manifesting instead in the skyrocketing costs of asset prices, housing, equities, healthcare, and education. During a currency reset, the dam holding this liquidity back finally breaks. The inflation previously absorbed and hidden within asset markets begins to overflow into the daily cost of living. Excess currency that once sat dormant in financial instruments suddenly begins chasing real goods. In this environment, cash is the most vulnerable position possible, as it possesses no yield, no hedge, and no structural protection to absorb the impact. History provides a grim map of this terrain. In 2018, Venezuela saw inflation reach a terrifying 1 million%, where an entire year's salary became worthless in weeks. Those who survived converted their bolivars into dollars, gold, or physical goods before the acceleration. Zimbabwe followed a similar pattern. Those who trusted the local dollar were destroyed, while those who moved into hard assets or foreign currencies preserved their power. Even in Argentina, in 2001, bank deposits were frozen and forcibly converted from US dollars to pesos at an artificial exchange rate, meaning citizens holding what they believed were dollar accounts woke up to find they held pesos. The lesson is structural. Cash is fundamentally a political instrument whose value is maintained solely by political will. And when political will fails, when fiscal mathematics overwhelm political capacity, cash becomes the mechanism through which wealth is transferred from citizens to the state. This does not mean cash is useless. This leads us to the third asset class that disintegrates during a currency reset: fixed income insurance products. This category includes annuities, pension buyouts, and whole life policies with cash value. Essentially any instrument that promises a fixed stream of currency payments over time. These products are expertly marketed as a sanctuary of safety and guaranteed income, designed to protect the vulnerable from market volatility. However, this is a dangerous structural illusion. An annuity functions much like a long-term government bond, but carries the heavy backpack of counterparty risk. You hand over a significant lump sum today in exchange for a fixed monthly payout for life. Yet while the insurance company guarantees the specific nominal number, they do not and cannot guarantee the value of that number. If inflation runs at a modest 3%, your payment's purchasing power is cut in half in 24 years. At 7%, that halving occurs in just 10 years. Should inflation hit 15%, you are effectively impoverished within a decade. The insurance company is not technically cheating you. They're paying exactly the figures stated in the contract. But the very currency used for those payments has been redefined beneath your feet. This is not speculation. This is historical record. In Germany after World War I, life insurance policies purchased with stable marks were eventually paid out in hyperinflated marks that had lost all utility. Families who had spent decades paying premiums received payouts that could not buy a loaf of bread. In Hungary in 1946, the collapse of the pengo was so total that prices doubled every 15 hours. The evaporation of wealth through insurance policies, pensions, and fixed annuities is rarely the result of a dramatic default. Instead, it is achieved through the cold, relentless logic of arithmetic. This was the grim reality for pensioners in Poland during the 1980s. After contributing their labor for an entire working life to state systems, they watched as their monthly payments dwindled until they were worth less than a single day's groceries. The structural hierarchy is clear. These instruments are denominated in currency, and the state holds absolute control over that currency. When a government faces a fiscal impossibility, it will invariably sacrifice the value of the currency to ensure its own survival. This is not a matter of systemic corruption, but a primal survival instinct of the state. From a governing perspective, allowing inflation to erode fixed promises is far more politically palatable than an explicit default or a direct tax hike. The victims of this erosion, the elderly and the dispersed, are often the most politically vulnerable, serving as a sacrificial buffer between the state and its insolvency. They are effectively the softest targets in the room, and thus they're the ones who pay the price. Today, the United States insurance industry holds approximately $8 trillion in assets to back these very promises. While these $8 trillion in dollar-denominated commitments will undoubtedly be honored in nominal terms, the haunting question remains as to what those dollars will actually buy. The fallout of the 1970s stagflation offers a clinical study in this destruction. As inflation accelerated, landlords watched their real returns vanish. Their rental income remained stagnant under fixed long-term leases, while property taxes, maintenance fees, and utilities climbed relentlessly, eventually forcing many into distressed sales. The peril deepens when capital controls enter the fray. When a government restricts the movement of money, buyers lose access to the financing or foreign currency required to transact, causing property values to crater. During the 2001 Argentine crisis, the real estate market plummeted by more than 50% in dollar terms. The buildings did not vanish. Rather, the pool of viable buyers simply evaporated. Certain categories of property carry even higher risks. Luxury estates and vacation homes are typically the first assets liquidated when wealth is frozen or destroyed. Because they possess high carrying costs, limited utility, and a total dependence on discretionary income, they often become unsellable at any price during a currency crisis. For real estate to survive a reset, it must be productive property, such as farmland or assets generating income through essential goods and services, ideally located in jurisdictions with a stable rule of law and owned outright. The last point regarding financing deserves emphasis. Consider a 30-year fixed-rate mortgage denominated in dollars. If the dollar loses 70% of its purchasing power, your debt has effectively been slashed by 70% in real terms. While the bank is technically paid in full in nominal terms, the same mechanism that liquidated the bondholder has effectively transferred wealth from the bank to the borrower. This is not subjective advice. It is financial physics. The exact force that destroys the lender and the cash holder serves to benefit the borrower and the asset holder. However, this only holds true if you have selected the right asset type. Property rights are maintained, and capital controls do not prohibit transfer. These are not small caveats. History shows that in every currency crisis, governments have imposed restrictions on property transactions. In Cyprus in 2013, capital controls prevented citizens from moving money out of the banking system. The case of Venezuela demonstrates the ultimate breakdown of the real estate myth. There, property transactions conducted in bolivars became entirely meaningless because the marketplace simply refused to accept the dying currency. This proves that real estate is not an inherently safe harbor. When held in the wrong form, within the wrong jurisdiction, or tied to a flawed financing structure, physical property can be just as financially destructive as a failing bond or a worthless annuity. Before any asset can be properly evaluated, the mechanical reality of the reset must be understood. History shows that when governments are cornered, they do precisely that. In 2010, the Hungarian government effectively nationalized private pension funds by presenting citizens with a coercive choice: transfer your private assets to the state system or forfeit your state pension benefits entirely. Facing this ultimatum, 97% of pension holders complied, moving over 10 billion euros from private hands into government control. Poland followed a similar script in 2013, seizing approximately 50% of private pension fund assets, specifically those parked in government bonds, and folding them into the state social security system. The official justification was debt reduction. The result was that citizens lost direct ownership of assets they had accumulated over decades. The precedent for such seizures is not confined to obscure history. It is a recurring feature of modern developed economies. In 2008, the Argentine government nationalized 10 private pension funds worth approximately $30 billion, absorbing those assets directly into the state system. Account holders who once held segregated investments suddenly found themselves entirely dependent on the shifting promises of a sovereign state. Ireland followed a similar path during its financial crisis, imposing a direct levy on private pension funds to bankroll a massive bailout. These events demonstrate that the protection of retirement assets is never absolute. It is a variable that fluctuates based on the desperation and necessity of the government in power. While the United States has avoided direct nationalization over the last 15 years, the structural prerequisites for such a move are undeniably present. The Social Security Trust Fund currently holds approximately $2.8 trillion in Treasury securities, yet these are not external stores of wealth. They are merely internal claims on future tax revenue. With the fund projected for exhaustion in 2033, the state will inevitably be forced to choose between slashing benefits, hiking taxes, or aggressive currency printing. Meanwhile, private retirement accounts represent a staggering pool of $35 trillion in U.S. retirement assets. This is captive capital that has no means of escape. It is a massive reservoir that can be taxed, regulated, or redirected as political necessity dictates. I am not predicting a specific catastrophe. I am observing that the current structure permits one. In the theater of financial history, crises eventually demand whatever the existing structures permit. This disaster is the inevitable result of impossible fiscal mathematics colliding with the uncompromising walls of political reality. Over many decades, governments accumulate a mountain of untouchable promises, ranging from pension and healthcare commitments to defense and infrastructure obligations. These liabilities compound until they become a sacred social contract. Eventually, however, the gravity of these promises exceeds the state's capacity to fulfill them through sustainable borrowing or traditional taxation. At this critical juncture, only three paths remain. The first is an explicit breach, cutting benefits and defaulting on bonds. This is a suicide mission for political careers that frequently topples entire governments. The second is a radical hike in explicit taxation, which suffocates economic growth and similarly invites political ruin. Consequently, decision-makers invariably choose the third path, the implicit breach. This mechanism allows the state to fulfill every promise in nominal terms while systematically hollowing out their real value. By paying every dollar promised while insuring those dollars by significantly less, the government employs a tool that is both invisible and deniable. This is the only option that is politically survivable, and it is chosen not out of malice, but out of a primal instinct for self-preservation. This strategy falls disproportionately on those who trusted the rules: the retirees, the savers, and the holders of fixed-income assets. If these vulnerable classes are forced to absorb the cost of the reset, one must ask who captures the benefit. The answer reveals a systematic transfer of wealth. The beneficiaries are those positioned in equities within essential industries, commodities, and productive real estate, as well as those holding foreign-denominated assets or debt that erodes in real terms. These winners are defined by their access to information and their geographical and financial mobility. They hold assets that are not trapped in rigid, fixed structures, because wealth can be restructured and moved, and because it can hire the elite advisors who perform the autopsy on these mechanisms before they accelerate. The beneficiaries are overwhelmingly those who are already wealthy. The middle class remains disproportionately anchored in the very asset classes destined to fail. Their wealth is concentrated in savings accounts, government bonds held within retirement funds, annuities pitched by insurance agents, and homes tethered to 30 years of mortgage payments. This is not a conspiracy. It is the inevitable outcome of a specific financial structure. These assets are held because the middle class was told they were safe, but that safety was defined merely as low volatility. In a stable system, low volatility mimics wealth preservation, yet volatility and risk are not the same thing. Low volatility assets can carry catastrophic risk. A government bond is like a dormant volcano. It does not fluctuate from day to day, but over decades, it can lose everything to tectonic fiscal forces that never appeared on a monthly statement. Every element of this pattern is currently in motion. U.S. federal debt now exceeds 120% of GDP, and interest payments have surpassed defense spending. The Congressional Budget Office projects permanent deficits regardless of economic performance. Furthermore, the Federal Reserve holds nearly $5 trillion in Treasury securities, representing monetized debt created by the government and bought with newly printed currency. Social Security and Medicare face combined unfunded liabilities exceeding $170 trillion in present value terms. These are promises that cannot be kept in real terms, yet they will be settled in nominal terms. Meanwhile, the average American retirement account is dominated by domestic equities and bonds denominated in dollars. There is minimal international diversification. Beyond the lack of geographic diversity, There's also minimal commodity exposure and virtually no protection against dollar devaluation. The average American currently holds the overwhelming majority of their liquid wealth in bank deposits and money market funds. These instruments are already failing to keep pace with inflation, meaning they're losing real-world purchasing power in real time. It is a sobering reality. The typical citizen is currently clutching a handful of paper promises while the few are securing productive assets. I am not predicting a specific date for a collapse, nor am I predicting a single trigger. However, I am observing that the structural prerequisites for a currency reset are undeniably present. The asset classes most widely held by the American middle class today are precisely the same ones that have failed in every historical precedent. This perspective is not one of pessimism. It is one of pattern recognition. The purpose of this analysis is not to generate fear, as fear is an entirely useless emotion in this context. Fear leads only to paralysis, and that paralysis is the very thing the current structure depends upon to maintain its momentum. The goal is instead to illuminate the game board, demonstrating that what feels safe to the touch is often what is most exposed to the flames. True safety in a shifting system is found not by hiding from volatility, but by mastering the understanding of structural risk. Resets are not a matter of if, but when. They have occurred repeatedly throughout human history and will inevitably happen again. The only remaining questions are those of timing and magnitude. You must look at the game board and ask where your wealth is actually positioned. Are you holding currency or claims on real things? Are you holding trapped capital or true optionality? Are you positioned to absorb the cost of a reset? Or are you prepared to adjust when the rules of the game change? These are not mere investment questions. They are structural inquiries that require a deep understanding of the mechanism. This analysis is strictly for historical and educational purposes and does not constitute financial advice or a recommendation to buy or sell any asset. Every individual situation is different, and you should consult qualified professionals before making any financial decisions. The weight of historical evidence suggests that systemic failure is a recurring feature of the modern age. In 1923, German citizens who had dedicated their entire lives to working and accumulating marks were stunned to find their entire net worth would not cover a single week of groceries. By 2001, savers in Argentina who had placed their faith in banks, their government, and their financial advisors discovered that blind trust provides no hedge against a collapsing currency. This theme echoed through Iceland in 2008, where depositors in the nation's three largest banks learned that deposit insurance is only as resilient as the sovereign guarantor that backs it. In 2013, the residents of Cyprus with bank deposits exceeding 100,000 euros watched as their funds were confiscated overnight to salvage a broken banking system. These are not tales from ancient history. They are modern events occurring in developed economies with educated populations and sophisticated financial networks. The mechanism of failure and the specific asset classes that disintegrate remain remarkably consistent across time. While history does not repeat itself, it rhymes with uncomfortable precision, and the pattern is currently in motion once again. The central conflict is not whether such an event will occur. It happens repeatedly and documentably, but whether it happens while an individual is left holding the wrong assets. Understanding these ignored mechanisms is a form of performing autopsies on financial systems before they fail, illuminating patterns that typically only become visible in the clarity of hindsight. Most people will never study these cycles until the cost has already been paid in full. However, those who understand the mechanism have the rare opportunity to position themselves in advance, approaching the horizon with clarity rather than panic or fear. This analysis of historical resets provides the tools to see what others miss before the next chapter of the cycle unfolds.